Before we begin, a quick and important disclaimer. The information presented in this video is for educational and entertainment purposes only. This is a theoretical and statistical analysis of a niche financial concept. This content does not constitute professional legal, financial, insurance, or tax advice. Divorce laws, marital property regulations, and insurance statutes vary significantly by state and jurisdiction. The concepts discussed are based on historical trends and mathematical models, not on specific products currently available or endorsed. You should always consult with a qualified attorney or certified financial planner regarding your personal circumstances and conduct your own due diligence before making any major financial or contractual decisions. Every year in the United States, we spend over $70 billion on weddings. We invest in the flowers, the catering, the venues, and the photographers, creating a massive economic engine built on the celebration of a permanent union. However, while we have an entire industrial complex dedicated to the commencement of marriage, there is a staggering multi-billion-dollar void on the other side of that equation. Statistically, roughly 40 to 50% of first marriages in the United States end in divorce, with that percentage climbing even higher for second and third marriages. This represents a massive unmanaged financial risk that affects millions of Americans every single year. We insure our homes against fires that have a less than 1% chance of occurring. We insure our cars against accidents that happen at a fraction of the frequency of marital dissolution. And yet, for the most significant financial contract the average person will ever sign, a marriage license, there is virtually no viable insurance product to mitigate the devastating economic fallout of its failure. Consider the case of the average contested divorce in the U.S. Depending on the complexity of assets and the presence of children, legal fees and court costs typically range from $15,000 to $30,000 per person. In high-conflict cases, these numbers can easily spiral into six figures, effectively liquidating the very assets the couple spent decades building. We are looking at a systemic destruction of generational wealth that occurs in the shadows of our economy. If we look at the historical trends of household stability, the financial trajectory of a single person following a divorce often shows a permanent downward shift in net worth, particularly for women and custodial parents. This brings us to a radical, uncomfortable, yet mathematically fascinating question. Why does divorce insurance not exist as a standard financial product? If the risk is so prevalent and the cost is so high, why hasn't the free market provided a solution? In this deep dive, we are going to strip away the emotion, the stigma, and the social taboos to perform a cold, hard statistical analysis of the theoretical market for divorce insurance in America. We are going to explore the actuarial science of heartbreak and the economic hurdles that have prevented insurance giants from entering this space. We will examine the concepts of adverse selection and moral hazard, the two primary reasons why the traditional insurance model breaks down when applied to the sanctity of the home. We will look at historical case studies of companies that attempted to launch marriage protection products and failed, and we will analyze how modern big data and predictive modeling could potentially change the landscape of marital risk management in the 21st century. The problem this solves for you today is one of fundamental risk literacy. Whether you are currently married, considering it, or even if you have already navigated a divorce, understanding the market mechanics of marital dissolution is essential for protecting your long-term financial health. The current solution for this risk is the prenuptial agreement. But as we will see, prenups are a legal tool, not a financial hedge. They dictate how the remaining pie is sliced, but they do not add any money back into the pie to cover the cost of the slicing itself. Divorce insurance in its theoretical form would be a casualty product designed to provide a cash benefit to cover legal fees, relocation costs, and the sudden loss of a dual-income household. It is the missing piece in a comprehensive wealth management strategy. To understand the scale of this theoretical market, we must first look at the sheer volume of the divorce tax paid by the American public. When a household splits, the cost of living does not just double. It often triples due to the loss of economies of scale. You now have two mortgages or rent payments, two sets of utility bills, and two sets of household expenses, often funded by the same pool of income that previously supported one residence. Historically, the poverty rate for divorced women is significantly higher than for married women, and the impact on retirement savings is often catastrophic. This isn't just a personal tragedy. It is a macroeconomic leak. By the end of this masterclass, you will understand how actuaries view your relationship status, how the law of large numbers applies to your living room, and what the future of automated, data-driven marital risk protection might look like. We are going to walk through the step-by-step process of how a divorce insurance policy would be underwritten. Imagine an insurance adjuster looking at your social media activity, your credit score, the age at which you married, and your educational background to determine your risk premium. We will look at the data points that correlate most strongly with marital longevity, such as the wedding cost paradox, where studies have shown that couples who spend more on their wedding are actually statistically more likely to divorce. We will discuss the adverse selection problem in depth, the idea that the only people who would want to buy divorce insurance are the people who think they are likely to get divorced, which is the same reason why you can't buy fire insurance while your curtains are already on fire. This is a masterclass in the intersection of sociology and economics. We are going to look at the wedlock case study, a product launched in the late 2000s that attempted to provide a divorce life insurance policy. We will analyze why it struggled to gain mainstream traction and how it attempted to solve the problem of moral hazard, the risk that a person might intentionally end their marriage just to collect the insurance payout. We will contrast the American legal system's no-fault divorce laws with the insurance requirements for a covered peril. The promise of this analysis is to give you a new lens through which to view your financial future. We are moving past the romanticized version of the American dream and looking at the actuarial reality of modern life. We are going to provide you with the statistical tools to quantify a risk that most people are too afraid to even name. By the time we finish this 10-part series, you will have a comprehensive understanding of why your insurance agent isn't calling you about your marriage, and what you can do to build your own theoretical insurance fund, using the same principles used by the world's largest hedge funds and insurance syndicates. This is about taking control of the one variable that most people leave entirely to chance. We are breaking down the wall between the heart and the spreadsheet. Let's look at the numbers. To understand the numbers, we have to look at the wreckage first. In 2026, the average cost of a contested divorce in a major American metropolitan area has ballooned to over $45,000 per person. This is not just a fee for a service. It is a massive transfer of wealth from families to the legal industrial complex. Imagine a couple named Alex and Jordan. They represent the quintessential American success story of the mid-2020s. They both work in high-growth tech sectors. They own a home in a suburb of Austin with a mortgage rate they locked in before the 2023 spikes, and they have 2 children. Their combined household income is $250,000. On paper, they are the picture of stability. However, the moment they decide to file for dissolution, that stability evaporates. The immediate financial hit is the retainer fee, which in 2026 for a high-net-worth individual often starts at $10,000. That money is gone before a single document is filed in court. Then comes the valuation of assets. In a high-inflation environment, the cost of appraising a home, valuing a 401k, and calculating the future value of stock options can eat another $5,000 to $10,000. By the time they reach a settlement, Alex and Jordan have effectively set fire to $100,000 of their children's future college tuition. This is what economists call a deadweight loss. It is money that leaves the family unit and never returns. This is the precise risk that, in any other sector of the economy, would be mitigated by a robust insurance market. If you bought a car for $100,000, you would never dream of driving it off the lot without a policy. Yet, we enter into the most expensive contract of our lives, marriage, with zero casualty protection. The reason this market remains theoretical is rooted in 2 fundamental pillars of insurance theory: adverse selection and moral hazard. To understand why your local insurance agent doesn't offer a divorce rider, we have to look at the historical trends of how insurance companies evaluate risk. Insurance works by pooling the premiums of many to pay for the losses of a few. This requires a predictable, somewhat random distribution of risk. But divorce is rarely random. This leads us to our first major hurdle: adverse selection. Imagine if you could buy an umbrella only when you saw clouds forming. The insurance company would go bankrupt because they would only be collecting premiums from people who were certain they were about to get wet. In the context of divorce insurance, the people most likely to sign up for a policy are those who already suspect their marriage is on the rocks. If the only people buying the product are the ones who are statistically certain to use it, the premiums would have to be so high that they would equal the payout, rendering the insurance pointless. In 2026, with the advent of sophisticated data tracking, insurance companies are even more terrified of this. They know that if they launched a product today, the first people to sign up would be those whose search histories are already filled with queries about child custody laws and hidden bank accounts. Then we have the second pillar: moral hazard. This is the insurance term for the risk that the existence of a policy will actually change the behavior of the policyholder in a way that makes the insured event more likely to happen. Think of it like this. If you have a fire insurance policy that pays out 3 times the value of your house, you might be a little less careful with where you leave your candles. In the world of divorce insurance, the fear is that a significant cash payout might lower the threshold for a couple to work through their problems. If things get difficult, and there is a $50,000 check waiting on the other side of a filing, does that change the incentive structure for staying together? Actuaries have struggled for decades to find a way to price this risk without inadvertently incentivizing the breakdown of the American family unit. Despite these hurdles, there have been historical case studies of entrepreneurs who tried to crack this code. The most famous attempt was a company called Safeguard Guarantee Corporation, which launched a product called Wedlock in the late 2000s. It was a fascinating, albeit flawed, experiment in marital risk management. Wedlock didn't call itself insurance in every state to avoid certain regulatory hurdles, but it functioned as a casualty product. You would buy units of protection. One unit might cost $15 a month and provide a $1,200 payout in the event of a divorce. To combat the adverse selection problem, they implemented a mandatory 48-month waiting period. You had to be married and paying into the system for 4 years before you could ever see a dime. This waiting period was a crude but necessary mathematical tool. The theory was that if a couple could survive 4 years while paying for divorce insurance, they probably weren't planning on getting a divorce when they signed up. It was an attempt to filter out the high-risk, immediate payout seekers. However, the math still didn't quite work. The company struggled with the reality that the divorce rate in the United States isn't a flat line. It peaks and valleys based on economic conditions, social shifts, and even the ages of the children in the household. Safeguard eventually faced regulatory scrutiny and financial pressures that led to its decline, but it left behind a blueprint for what a modern version might look like. In 2026, the potential outcomes for a revived version of this product are much different because of the sheer volume of data we now generate. We are living in an era where an algorithm can predict a breakup with startling accuracy, based on changes in language patterns in text messages or shifts in spending habits. If an insurance company could tap into this data, they could theoretically underwrite a policy with the same precision they use for a life insurance policy. They could look at your debt-to-income ratio, your educational attainment, and even the stability of your employment to create a personalized risk profile. Imagine a scenario where a young couple in 2026, let's call them Mia and Ethan, are getting married. They are both 24, they have significant student loan debt, and they are moving to a city with a high cost of living. Statistically, they are in a high-risk category. A theoretical insurance company might offer them a policy, but the premium would be substantial. Conversely, a couple in their 40s with established careers and high credit scores might be offered a much lower rate. This brings up a massive ethical and social question. Would the existence of divorce insurance create a two-tiered system of marriage, where only the statistically stable can afford to protect themselves from the financial fallout of a split? We are seeing historical trends where the marriage rate is declining, while the cost of divorce is rising. This creates a massive market gap. There is a generation of young Americans who are terrified of the financial ruin associated with divorce, and they are choosing to opt out of marriage entirely as a form of risk management. If a viable divorce insurance product existed, it could potentially act as a stabilizer for the institution of marriage by removing the fear of total economic collapse. But to get there, we have to solve the problem of how to measure the unmeasurable, human emotion and commitment. As we move forward in this analysis, we have to look at the actual line items of a divorce settlement in 2026. We are not just talking about splitting the house and the cars anymore. We are talking about the division of digital assets, cryptocurrency portfolios, and even the future earnings potential of a spouse who was supported during medical school. The complexity of the modern American estate has made the need for a financial safety net more pressing than ever before. But how do you price a policy for someone with a volatile income or a portfolio of non-fungible tokens? The answer might lie in a concept called parametric insurance. This is a type of insurance that pays out a set amount based on a specific trigger event, rather than an assessment of the actual loss. In the next part of this deep dive, we are going to explore how a parametric model could revolutionize the divorce insurance market. We will look at how blockchain technology and smart contracts could automate payouts the second a divorce decree is uploaded to a public registry, bypassing the months of legal bickering over expenses. We will also examine the shocking data that suggests that certain zip codes and even certain career paths are almost uninsurable when it comes to marital longevity. If you thought your credit score was the most important number in your life, wait until you see your marital stability score. The algorithms are already calculating it, they just haven't shown you the results yet. In Part 3, we reveal the data points that determine who stays together and who pays the price. The marital stability score is not some far-off science fiction concept. By 2026, the technology to aggregate and analyze personal data has reached a point where a theoretical insurance underwriter could predict the longevity of a relationship with more accuracy than the couple themselves. If you look at the historical trends in consumer data, we are already providing the building blocks for this score every time we swipe a credit card or update a social media status. To an actuary, your marriage is not a romantic bond. It is a series of overlapping risk variables. Let us break down the specific data points that would constitute a modern underwriting profile for a divorce insurance policy. The first and most controversial metric is the wedding cost paradox. Historical studies, most notably from researchers at Emory University, have indicated a significant inverse correlation between the amount spent on a wedding and the duration of the marriage. Specifically, couples who spend more than $20,000 on their wedding are statistically more likely to see their union dissolve than those who spend between $5,000 and $10,000. From a theoretical insurance perspective, a high-spend wedding is a red flag. It suggests a focus on the event rather than the partnership, and more importantly, it often indicates the immediate accumulation of high-interest consumer debt at the very start of the union. In 2026, an underwriter would likely offer a discount on premiums for couples who opt for a courthouse wedding or a small, low-cost gathering, as these are seen as indicators of financial prudence and long-term stability. Next, we look at the age and education gap. The data shows that the age at which a couple marries is a primary driver of risk. Marrying before the age of 25 is often flagged as high risk due to the lack of financial maturity and the higher likelihood of significant life changes in the ensuing decade. Conversely, marrying after the age of 32 has also shown a slight uptick in dissolution rates in recent years, a phenomenon some sociologists attribute to the settled in my ways effect. Furthermore, education levels are a massive stabilizer. Statistically, a household where both partners have at least a bachelor's degree has a significantly lower probability of divorce compared to households with lower educational attainment. This is not about intelligence. It is about the historical trend that higher education often leads to more stable, higher-paying careers, which mitigates the number one cause of marital strife: financial pressure. Imagine if you were the underwriter for a couple named Sarah and David in 2026. Sarah is a 30-year-old nurse practitioner with a stable income and low debt. David is a 32-year-old marketing consultant with a fluctuating income and significant student loans from an unfinished MBA. They have been together for 3 years and are planning a $50,000 wedding. Under the traditional risk model, David's volatile income and the high wedding costs would spike their premium. However, a modern theoretical insurer would look deeper into their digital breadcrumbs. In 2026, these breadcrumbs include things like sentiment analysis of communication. If David and Sarah's shared calendar shows a high frequency of joint activities and their public social interactions use a high ratio of we and us versus I and me, an AI-driven underwriting tool might actually lower their risk score. This is where the concept of the marital stability score becomes hyper-personalized. We are talking about analyzing the inter-arrival time of text messages or the commonality of spending categories. If both Sarah and David spend a consistent percentage of their income on shared experiences, like travel or home improvement, rather than individual escapism, like separate luxury goods or high-frequency gambling, the risk of a lifestyle-driven dissolution drops significantly. Now let us address the geography of risk. In the United States, the legal framework of the state where you reside is a massive variable in the theoretical cost of a divorce insurance payout. This brings us back to the difference between community property states like California and Texas, and equitable distribution states like New York or Florida. In a community property state, assets acquired during the marriage are typically split 50-50, regardless of who earned the money. This makes the financial outcome of a divorce highly predictable, which insurers love. Predictability allows for more accurate pricing. However, in equitable distribution states, the court has much more leeway to divide assets based on what is fair, which can lead to prolonged, expensive legal battles as each side argues their contribution to the marriage. A theoretical divorce insurance policy in 2026 would likely feature a state-based surcharge. If you live in a state where the legal process is notoriously litigious and slow, such as Connecticut or New Jersey, your premiums would be 30 to 40% higher than if you lived in a state with a more streamlined, formulaic approach to asset division. This is because the proof of loss in a divorce insurance scenario isn't just the divorce decree. It is the total cost of reaching that decree. If the legal fees for a standard divorce in your zip code average $30,000, the insurance company has to price your policy to cover that potential liability. To bypass the messiness of traditional insurance claims, we have to talk about parametric insurance and the role of the blockchain. In a traditional model, you would submit your legal bills to the insurance company, an adjuster would review them, and then they would issue a reimbursement. This is slow and prone to disputes. In a parametric model, the policy is built on a smart contract. The trigger is simple and objective, the filing of a petition for dissolution of marriage in the public court records. Imagine if Mia and Ethan, our couple from the previous part, had a parametric policy. The moment the county clerk's digital system logs their divorce filing, the smart contract detects the event via an oracle, a data feed that connects the real world to the blockchain. Within minutes, a predetermined retainer payout of $15,000 is deposited into a restricted account that can only be used for legal fees. There is no need for an insurance adjuster to interview the couple, or for Mia to prove that Ethan was at fault. The payout is triggered by the data point alone. This removes the moral hazard of fighting over a payout, because the amount is fixed at the start of the policy. However, this brings us to a massive open loop in our analysis. If the payout is automated and the data is so precise, why hasn't a major tech giant like Amazon or Google, who already possess most of this data, launched Google Protect, Marriage Edition? The answer lies in the dark side of predictive modeling. If an algorithm determines that your marriage has an 85% chance of failing within 5 years based on your spending and communication habits, should it even be legal for an insurance company to use that data? Does knowing your marital stability score actually create a self-fulfilling prophecy, causing the very divorce it was meant to insure against? In Part 4, we are going to dive into the black swan events of marriage. We have talked about the predictable risks like debt and age, but what about the unpredictable? We will look at the statistical impact of infidelity clauses in theoretical insurance, and how companies might try to track the untrackable. We will also examine the shocking correlation between a sudden windfall, like a lottery win or a massive inheritance, and the immediate spike in divorce risk. If you think you are safe because you are financially secure, the data might suggest otherwise. We will explore why the wealthiest zip codes in America often have the most expensive insurance premiums for this theoretical product, and what that means for your personal wealth management strategy. The numbers don't lie, but they often tell a story we aren't ready to hear. In the realm of financial theory, a black swan event is an occurrence that is highly improbable, difficult to predict, and carries a massive impact. In the context of a marriage, we often view the breakdown of a union as a slow burn, but the data suggests that many divorces are triggered by sudden, localized black swans that would be a nightmare for any insurance underwriter to price. To understand the theoretical market for divorce insurance, we have to look at these unpredictable ruptures and how a 2026 actuary would attempt to quantify the unquantifiable. We begin with the most volatile variable, the infidelity peril. In traditional insurance, a peril is the cause of a loss, like a fire or a flood. In the historical trends of American divorce, infidelity remains one of the primary drivers of immediate filing. If we were to design a policy in 2026, how would an insurer handle a claim based on a breach of the marital contract? Imagine if a policy included a lifestyle clause. For the insurer, this presents a massive verification problem. Unlike a car accident where there is physical damage and a police report, infidelity is often handled in the shadows. However, in 2026, the digital footprint of the average American provides a terrifyingly clear picture of behavior. An insurer might offer a lower premium if a couple agrees to a continuous verification protocol. This could involve the voluntary sharing of GPS data, shared access to financial statements to flag unexplained expenditures at high-end hotels or jewelry stores, and even sentiment analysis of communication patterns with third parties. From a statistical standpoint, the risk of infidelity is not evenly distributed. It correlates with high-stress occupations, frequent solo travel, and significant discrepancies in social capital between partners. An underwriter would look at the historical trends of your specific career path, for example, the divorce rates for pilots or surgeons compared to those of archivists or software engineers, to determine the probability of a black swan event occurring in your household. This brings us to the windfall effect, a phenomenon that has baffled sociologists, and would be a central focus of any marital risk model. There is a persistent myth that financial security saves marriages. While it is true that poverty is a major stressor, the data shows a different, more complex reality when it comes to sudden wealth. Imagine a couple in 2026, Liam and Sophia. They have been married for 12 years, living a stable upper-middle-class life in a suburb of Denver. Suddenly, Liam receives a massive inheritance from a distant relative, or perhaps a long-dormant cryptocurrency portfolio he forgot about in 2017 skyrockets in value, netting him $5 million. Statistically, this windfall does not always strengthen the bond. In many case studies, it acts as an accelerant for an exit. Economists refer to this as the autonomy threshold. When a partner who was previously tethered to a marriage for financial stability or shared resource management suddenly gains individual wealth, the cost of leaving drops to near zero. The windfall provides the liquidity needed to fund a high-end legal team and a separate residence. For a theoretical divorce insurance provider, a sudden increase in a policyholder's net worth would actually trigger a premium hike rather than a discount. The insurer would view Liam's new $5 million as a high-risk indicator that he might choose to exercise his exit option. This is the irony of the market. As you become more financially successful, you become a higher risk for marital dissolution insurance. Now, let us examine the geography of risk through the lens of wealthy zip codes. If you look at the historical trends in areas like Palo Alto, California, or the Upper East Side of Manhattan, the divorce rate isn't necessarily higher than the national average, but the cost per divorce is exponentially greater. In 2026, the complexity of assets in these regions is staggering. We are no longer just splitting a house and a savings account. We are talking about the valuation of carried interest in private equity firms, the future royalties of AI-generated intellectual property, and the division of fractionalized real estate holdings. In a high-net-worth divorce, the forensic accounting fees alone can reach 6 figures. Imagine if an insurer had to pay out a claim for a couple in a zip code where the average legal bill is $200,000. The premium for such a policy would be astronomical, potentially costing more per year than a high-end umbrella policy or luxury car insurance. This leads to a theoretical market failure. The people who need the insurance the most, those with the most to lose, are the ones who are the most expensive to insure. We see potential outcomes where divorce insurance becomes a product for the middle class, while the ultra-wealthy continue to rely on increasingly aggressive and complex prenuptial agreements. Furthermore, we must consider the risk of the career pivot. In 2026, the American workforce is more fluid than ever. If one spouse decides to leave a stable corporate job to pursue a high-risk entrepreneurial venture, the marital dynamic shifts. This is a form of moral hazard. The spouse who remains in the stable job is essentially subsidizing the risk of the other. If the venture fails, the financial strain increases the likelihood of divorce. If the venture succeeds wildly, we run back into the windfall effect and the autonomy threshold. A theoretical insurance policy would likely require a re-underwriting event whenever a spouse makes a significant career change. This would function much like a home inspection after a major renovation. The insurer needs to see if the new structural integrity of the household can support the change in the financial foundation. But what happens when the risk isn't internal? What if the risk is the legal system itself? In Part 4, we have to address the concept of regulatory drift. Insurance companies rely on stable laws to price their products. However, divorce laws in the United States are subject to the whims of state legislatures. If a state suddenly changes its laws regarding permanent alimony or the division of non-marital assets, the entire actuarial table for that state becomes obsolete overnight. This is why, in 2026, any theoretical divorce insurance product would likely be structured as a surplus lines product, meaning it sits outside the standard regulated market and can adjust its prices and terms much more rapidly than your standard homeowner's policy. The data points we are uncovering suggest that the market for divorce insurance is not just about protection. It is a mirror reflecting the inherent instability of the modern social contract. We are seeing a world where your relationship is scrutinized by the same cold, calculating logic that determines the price of your life insurance. But there is a massive problem looming on the horizon that we haven't touched on yet. If insurance companies start successfully pricing the risk of divorce, and they start paying out claims, how will the United States government react? We are entering a territory where the private market might actually have a vested interest in the outcome of your marriage. Would an insurance company offer you a discount if you attended mandatory marriage counseling? Would they send you an alert on your phone if their AI detected a spike in conflict language in your household? We are moving from the realm of simple financial protection into the realm of behavioral modification. In Part 5, we are going to look at the legal and ethical war that would erupt if divorce insurance became a mainstream reality. We will explore the state versus syndicate battle, and the shocking reason why some politicians want to ban this product before it even reaches the masses. The next part reveals the one thing that could make this entire market illegal before you even get a chance to sign a policy. The one thing that could make the entire market for divorce insurance illegal before you even have the chance to sign a policy is a legal doctrine known as public policy. In the United States, a contract can be perfectly logical, mathematically sound, and mutually agreed upon, yet still be rendered completely void if a court determines that it violates the fundamental interests of society. Historically, the American legal system has viewed any contract that facilitates or encourages the dissolution of marriage as a violation of public policy. This is why, for over a century, the concept of a financial product that pays out upon divorce has been treated with the same legal skepticism as a bet on the outcome of a criminal trial. Imagine a scenario in 2026 where a state legislature, perhaps in a state like Ohio or Florida, is holding a hearing on the proposed Marital Stability and Protection Act. On one side, you have the actuarial syndicates arguing that divorce is a quantifiable financial hazard that leaves thousands of families in ruins every year. They present data showing that the potential outcomes of providing a liquidity buffer during a split could actually reduce the strain on state-funded social services. On the other side, you have traditionalists and state regulators who argue that the moment you put a price tag on the end of a marriage, you have created a perverse incentive for that marriage to fail. This is the core of the legal war. Is divorce insurance a safety net for a catastrophe, or is it a bounty on the head of a relationship? The historical trends in American contract law suggest that for divorce insurance to become legal and mainstream, it must overcome the hurdle of being classified as an aleatory contract that promotes social harm. In the past, courts have struck down prenuptial agreements that were seen as too generous toward the spouse who initiates the divorce, fearing it would make the exit too tempting. To navigate this in 2026, theoretical insurance companies would have to structure their policies as indemnity products rather than simple cash payouts. This means the policy would not just hand you a check for $50,000. It would specifically reimburse documented losses, such as legal retainers, court costs, and the documented expenses of moving to a new residence. By tying the payout to specific, painful costs, the insurer attempts to neutralize the argument that the policy makes divorce profitable. Let us look at a case study involving a fictional citizen named Marcus in 2026. Marcus is a high-earning software architect who wants to buy a divorce policy to protect his assets. If the law views his policy as a form of gambling, it is illegal. But if Marcus can prove that he has an insurable interest in the continuity of his household's economic output, the legal standing shifts. An insurable interest is the legal requirement that the person buying the insurance must actually suffer a financial loss if the event occurs. In a marriage, the loss of a dual income stream and the sudden division of a retirement account are clear financial losses. However, the legal debate in 2026 centers on whether the state has a superior interest in keeping that marriage together, even at the cost of the individual's financial ruin. This brings us to the concept of regulatory drift. If the federal government or individual states decide that the high rate of divorce is a systemic risk to the American economy, they might actually pivot and encourage the development of these products. We could see potential outcomes where divorce insurance is treated similarly to health insurance, a necessary evil that keeps the gears of the economy turning during personal crises. But this creates a new ethical battlefield: data privacy versus underwriting accuracy. For an insurer to accurately price a policy for someone like Marcus, they would demand access to his most private data. We are talking about the frequency of his arguments, his location data, and even his physiological stress levels recorded by his smartwatch. Imagine if Marcus's insurer, a hypothetical company called Union Shield, monitors his biometric data and notices a spike in cortisol levels every evening when he arrives home. In 2026, the insurer's algorithm might interpret this as a high-risk indicator for marital discord. To mitigate their potential loss, Union Shield might trigger a loss mitigation clause. This is where the insurance company moves from being a passive observer to an active participant in your marriage. The policy could mandate that Marcus and his spouse attend a specific number of marriage counseling sessions, or use a mediated communication app to resolve disputes. If they refuse, their premiums could double or their coverage could be canceled. This creates a terrifying legal paradox. On one hand, the insurance company is actively trying to save the marriage to avoid paying out a claim. On the other hand, the constant surveillance and mandatory interventions could create so much stress that they actually cause the very divorce they were meant to prevent. This is what legal scholars in 2026 call the actuarial interference. Does a private corporation have the right to intervene in the most private aspects of American life, under the guise of financial risk management? The historical trends of the 2020s suggest that Americans are increasingly willing to trade privacy for financial security, but the marriage contract might be the final line in the sand. Furthermore, we have to address the third-party interest problem. In a traditional insurance market, you can only insure things you own. But in 2026, we might see the rise of the parental policy. Imagine if a wealthy set of parents, concerned about their child's choice of a spouse, tries to take out a divorce policy on their child's marriage. They have a clear financial interest. They might have provided the down payment for the house, or set up a trust fund that they want to protect. This would almost certainly be declared illegal under current and projected public policy laws, as it creates a situation where a third party stands to profit from the destruction of a marriage they aren't even a part of. This is the dark side of the theoretical market, the transition from personal protection to predatory speculation. The legal battle over divorce insurance will likely be fought in the fine print of what constitutes a covered peril. In a standard homeowner's policy, a fire is a covered peril, but arson is not. In a divorce policy, how do you define the difference? If one spouse is found to have intentionally sabotaged the marriage to trigger the insurance payout, that is insurance fraud. But how do you prove intent in the complex, emotional landscape of a failing relationship? In 2026, we could see the emergence of divorce adjusters, specialized professionals who investigate the causes of a marital breakdown with the same clinical detachment as a fire marshal investigating a warehouse blaze. They would interview friends, analyze digital records, and look for signs of intentional dissolution. As we look at the statistical landscape, the sheer complexity of these legal and ethical hurdles is what has kept the major players on the sidelines. But there is a silent shift happening. While the big insurance companies are waiting for legal clarity, a new breed of decentralized peer-to-peer risk pools is emerging on the margins of the economy. These groups are using private contracts and digital assets to build their own versions of divorce insurance outside the reach of state regulators. This brings us to a massive looming question that we haven't even touched on yet. If the private market and the government can't agree on how to insure a marriage, what happens when the risk becomes so large that it starts to threaten the stability of the entire U.S. housing market? In Part 6, we are going to look at the correlation of collapse. We will explore the data that shows how the divorce rate is the single greatest predictor of home foreclosures and mortgage defaults in America. We will analyze how a theoretical divorce insurance product could have prevented the 2008 housing crisis, and why the next economic downturn might be driven by the lack of marital risk management. We are going to look at the specific zip codes where a spike in divorces is already causing property values to crater, and what you can do to protect your equity when your neighbors start splitting up. The relationship between your heart and your home's value is closer than you think, and the numbers are about to get very uncomfortable. The relationship between your heart and your home's value is closer than you think, and the numbers are about to get very uncomfortable. In 2026, the American housing market is increasingly sensitive to what economists call forced liquidations. When we look at the historical trends of the last few decades, we see a recurring pattern where the stability of a local real estate market is tethered directly to the stability of the households within it. A divorce is not just a legal dissolution. It is an economic explosion that radiates outward, affecting property values across entire zip codes. To an actuary, a high-divorce neighborhood is a high-risk neighborhood for mortgage lenders. And this is where the theoretical market for divorce insurance finds its most powerful use case. As a stabilizer for the American dream, let us examine the divorce real estate feedback loop. When a couple like Sarah and Michael, living in a planned community in the suburbs of Phoenix, decide to split in 2026, they face an immediate liquidity crisis. They have $400,000 in home equity, but they cannot spend a brick. To divide the asset as mandated by their settlement, they must sell the property. Because they are often in a rush to move on or are facing mounting legal fees, they are more likely to accept a price 5 to 10% below the fair market value just to close the deal. In a tightly knit suburban market, this sale becomes the new comparable for every other house on the block. Suddenly, every neighbor's home value has been artificially suppressed because of one couple's marital failure. Imagine if you are their neighbor, a character we will call Robert. Robert has done everything right. He pays his mortgage on time, maintains his yard, and has a stable career. Yet, His net worth just dropped by $30,000 because Sarah and Michael couldn't make it work. This is a classic example of an unmanaged externality. If Sarah and Michael had a divorce insurance policy, the potential outcomes for the entire neighborhood would shift. The policy would provide a liquidity injection, perhaps a payout of $50,000, allowing them to maintain the mortgage payments on 2 separate residences for a year. This would remove the pressure for a fire sale, allowing them to wait for a market-rate buyer. In this scenario, the insurance isn't just protecting the couple. It is acting as a price floor for the local economy. Historically, if we look back at the 2008 housing crisis, the data reveals a chilling correlation. Financial stress led to a spike in domestic conflict, which led to a spike in divorces, which led to a massive wave of forced home sales and foreclosures. It was a domino effect where the lack of a financial buffer in the home resulted in a systemic collapse. If the theoretical market for divorce insurance had been mature in 2008, it could have functioned as a circuit breaker. By providing families with the cash needed to navigate the transition without abandoning their property, the depth of the housing crash could have been statistically mitigated. In 2026, the risk is even more acute due to the rise of the dual-income mortgage. The vast majority of American homes are now purchased based on the combined income of 2 partners. The moment one income is removed, the mortgage becomes unsustainable. Statistics show that the poverty rate for divorced individuals, particularly women, spikes in the first year following a split precisely because of housing costs. A theoretical insurance product would address this by offering a mortgage continuity rider. This rider would step in to cover the departing spouse's portion of the mortgage for a set period, preventing the default that often precedes a foreclosure. This brings us to the concept of the divorce contagion. Sociologists have long noted a statistical phenomenon where a divorce in a social group increases the likelihood of other divorces within that same group. When this happens at scale in a specific zip code, you get a localized real estate crash. In 2026, sophisticated real estate investors are already using AI to track these social signals. They look for clusters of divorce filings as a leading indicator of upcoming inventory and downward price pressure. If you are a homeowner, you are essentially competing against the marital stability of your neighbors. Let's dive into a step-by-step analysis of how an insurance company would price this real estate risk. An underwriter in 2026 wouldn't just look at your credit score. They would look at the turnover rate of your neighborhood. If you live in an area with a high density of young, dual-income families with high debt-to-income ratios, your divorce insurance premiums would be higher. Why? Because the probability of a neighbor's divorce dragging down your own home value is statistically greater. This is a form of collective risk. We see potential outcomes where homeowners associations might one day require all residents to carry a form of marital stability insurance, similar to how they require hazard insurance, simply to protect the aggregate property values of the community. But the complexity goes deeper when we consider the division of digital equity and modern assets. In 2026, a house isn't just a physical structure. It's often tied to smart home subscriptions, solar lease agreements, and complex tax incentives. Splitting these is a mathematical nightmare that adds months to the legal process. Each month the house sits in legal limbo is a month of potential market volatility. A divorce insurance policy could offer a valuation protection clause. This would compensate the policyholder if the value of the marital home drops significantly between the date of the divorce filing and the final date of the sale. This effectively hedges the real estate market risk that is inherent in a long-form legal battle. Consider the case study of a high-density urban area like Arlington, Virginia. In 2026, the market is dominated by high-end condos. When a couple divorces here, they don't just sell. They often have to deal with board approvals and high carrying costs. If 5% of the units in a building go on the market simultaneously due to a cluster of breakups, the building's reputation and value can take a hit. Insurance companies see this as a concentration of risk. They might limit the number of policies they write in a single building to avoid a massive payout event if a social or economic trend hits that specific micropopulation. The economic sinkhole of a divorce also includes the friction costs. 6% to real estate agents, 2% for closing, and the cost of moving. For $1 million home, that's $80,000 gone instantly. A theoretical insurance policy would aim to cover these friction costs. By neutralizing the cost of the move, the insurance allows the individuals to make more rational, less desperate financial decisions. We are moving toward a world where financial advisors will treat marriage not as a permanent state, but as a long-term contract with a high probability of a midterm renegotiation. This leads us to a shocking realization that many are not prepared for. If the housing market is so dependent on marital stability, and if insurance companies begin to master the data of divorce, who actually owns the risk? Is it the couple, the bank, or the insurance company? And what happens when the bank realizes that your marriage is more likely to fail than your roof is to leak? In 2026, we are seeing the first signs of mortgage lenders asking for marital risk disclosures. In Part 7, we are going to explore the intersection of the credit score and the marriage score. We will look at how the banking industry is quietly watching the development of the divorce insurance market to decide who gets a loan and at what interest rate. We will reveal the hidden data points in your credit report that already suggest your relationship is in trouble, and how a bank might use that information to call in a loan or deny a refinance. If you think your private life is separate from your borrowing power, you are decades behind the data. The next part reveals the algorithm that knows you're breaking up before you've even told your spouse. The algorithm that knows you are breaking up before you have even told your spouse is not a futuristic theory. In 2026, it is an operational reality for the shadow underwriters of the American financial system. While you might think of your marriage as a private emotional journey to a machine learning model, it is a sequence of highly predictable transactional triggers. To understand the theoretical market for divorce insurance, we have to look at how big data has effectively killed the concept of the private life. If an insurance company is going to offer you a policy to protect your assets during a split, they are going to do so by first mining your digital twin for every indicator of instability. This is the transition from actuarial tables based on age and zip code to behavioral underwriting, based on real-time micro-events. Historically, credit card companies have been the silent observers of marital collapse. A famous case study from the late 2000s revealed that some major card issuers actually lowered credit limits for customers who began seeing marriage counselors or moved into smaller apartments, as these were leading indicators of a coming default. In 2026, this has been refined into a science. Imagine a character named Tyler. Tyler lives in a trendy neighborhood in Charlotte, North Carolina. On the surface, Tyler's finances are impeccable. An 800 credit score, a manageable mortgage, and a high six-figure salary in renewable energy logistics. However, the bank's internal stability algorithm has just flagged Tyler's account with a yellow warning. Why? The algorithm isn't looking at Tyler's balance. It is looking at the velocity and category of his spending. In the last 3 months, Tyler has stopped making joint purchases at wholesale grocery stores and has shifted to high-frequency, single-serving meal kit deliveries. He has started spending more at high-end apparel retailers after 3 years of almost zero clothing expenditure. More tellingly, his GPS data, anonymously harvested through his banking app's location-based offers permission, shows that he is spending 3 nights a week at a gym across town that he never used to visit. To the algorithm, this is the financial DNA of a re-entry event. Tyler is preparing his dating market value for a return to the single life. In the theoretical market for divorce insurance, this data is the equivalent of a home insurance company detecting a smoldering wire behind your drywall. If Tyler were to apply for a new divorce insurance policy today, his premium would be 3 times higher than it was 6 months ago. In 2026, the potential outcomes for Tyler are dictated by these silent signals. When he goes to refinance his home or apply for a business line of credit, the bank might reject him, not because of his current income, but because their model predicts an 85% chance of a household dissolution within the next 18 months. Divorce is the single greatest cause of personal bankruptcy and mortgage default in the United States. And in 2026, lenders are no longer willing to ignore that correlation. Let us look at the specific data points that comprise the marriage score. The first is transactional decoupling. This is the step-by-step process of a couple separating their finances before the legal filing. It starts with a spike in cash withdrawals, often used to build an exit fund, that won't show up on a shared statement. It continues with the opening of individual utility accounts or phone plans. A theoretical insurance underwriter would use natural language processing to analyze the descriptions of transactions in a shared account. If the word I or my begins to replace our in memo lines, or if recurring joint subscriptions like streaming services or gym memberships are canceled in favor of individual accounts, the risk score hits the red zone. The second metric is social contagion data. Sociological studies have shown that if a close friend or family member gets divorced, your own probability of divorce increases by as much as 75%. In 2026, an insurance company wouldn't just underwrite you. They would underwrite your social graph. By analyzing public social media connections and shared interest groups, The insurer can see if you are part of a divorce cluster. If 3 of your closest contacts on a professional networking site or social platform have recently updated their status to single, the insurer views your marital contract as being under environmental stress. It is the social equivalent of living in a flood zone. Now, consider the role of sentiment analysis. In 2026, many smart home systems and communication apps have the capability, often buried in the terms of service, to perform tone and sentiment analysis on voice commands and text interactions. While they may not record the specific words for privacy reasons, they can record conflict frequency. If a smart speaker detects an increase in high decibel interactions or a decrease in the frequency of joint family mode usage, that metadata is gold for an insurance company. Imagine if your divorce insurance policy had a behavioral discount. You get 10% off your premium if your smart home data shows a consistent pattern of cooperative household management. It sounds like a dystopian novel, but in a world of high-risk financial products, the insurer demands the most accurate data possible to maintain their margins. This brings us to the intersection of the credit score and the marriage score. For decades, the FICO score has been the gatekeeper of the American middle class. But in 2026, the FICO score is seen as a lagging indicator. It tells the bank what happened yesterday. The marriage score is a leading indicator. It tells the bank what will happen tomorrow. If the bank can predict your divorce, they can predict your inability to pay back a loan. We are seeing potential outcomes where the availability of divorce insurance actually becomes a requirement for a high-value mortgage. The lender might say, "We will give you this $2 million loan, but only if you carry a divorce insurance policy that names the bank as the primary beneficiary in the event of a split." This turns the insurance product from a personal safety net into a systemic financial stabilizer. But there is a flaw in the algorithm, the false positive of the recommitment phase. Sometimes a couple goes through a period of intense conflict and financial decoupling, only to seek counseling and come out stronger. To a cold algorithm, the purchase of a marriage counseling retreat looks identical to the purchase of a divorce mediator's initial consultation. Both involve a high-cost payment to a relationship professional. This is where the theoretical market faces its biggest challenge. How do you distinguish between the death throes of a marriage and its renewal? If the insurance companies get this wrong, they end up charging the most loyal, hardworking couples the highest premiums, while missing the silent splitters who maintain a perfect facade until the day they file. To solve this, insurers in 2026 are looking at the one data point that is almost impossible to fake: the consistency of long-term financial goals. If a couple continues to contribute to a joint college fund for a child or a joint retirement account with the same frequency and volume over a decade, the risk of a sudden strategic divorce drops significantly. The implications of this are staggering for the average American household. We are entering an era where your marital health is a public financial metric. If you want to maintain your borrowing power, you have to maintain your stability image. But what happens when the algorithms start to influence your behavior? What if you stay in an unhappy marriage not for the kids, and not for the love, but because your marriage score is the only thing keeping your interest rates low and your insurance premiums affordable? In Part 8, we are going to look at the gaming the system phase. We will explore how savvy Americans in 2026 are using alibi services and financial masking to hide their marital problems from the insurance algorithms. We will look at the rise of dark credit and how people are building entire shadow financial lives to protect their marriage score while preparing for an exit. We are going to reveal the underground market for stability bots that simulate happy household data to keep the insurance adjusters at bay. The war between the couple and the computer is just beginning, and the stakes are your entire net worth. The war between the couple and the computer is just beginning, and the stakes are your entire net worth. In 2026, the concept of gaming the system has evolved from simple tax loopholes to the sophisticated manipulation of personal behavioral data. As the theoretical market for divorce insurance matures, we are seeing the emergence of an entire sub-economy dedicated to stability laundering. This is the practice of artificially inflating your marital stability score to keep insurance premiums low and credit accessibility high, even when the relationship is internally fracturing. To an actuary, a dip in the score is a signal to raise rates. To a couple in crisis, that rate hike is an additional financial burden they cannot afford, creating a feedback loop where the cost of the insurance itself becomes a driver of the divorce. Imagine a citizen named Chloe, a high-level project manager in Seattle. Chloe is well aware that her household's financial health is being monitored by a suite of passive underwriting tools. Her divorce insurance policy, which she and her husband took out 4 years ago, includes a dynamic premium adjustment clause based on their shared digital footprint. When the marriage begins to sour, Chloe doesn't just face emotional turmoil. She faces a calculated financial penalty if the insurance company's AI detects the shift. To prevent this, Chloe turns to a stability bot. This is a specialized AI service designed to mimic the digital behaviors of a happy, synchronized couple. The stability bot works by hijacking the couple's shared digital life to create a facade of normalcy. It generates a steady stream of automated, high-sentiment text messages between the spouses, ensuring the insurance company's communication monitors see a high frequency of cooperative language. The bot coordinates shared calendar events, dinner dates, weekend trips, and family outings that appear in their cloud-synced accounts, even if Chloe and her husband are actually spending those evenings in separate rooms. It even goes as far as to execute performative joint purchases. The bot might buy 2 tickets to a local theater or book a couple's massage, using a shared credit card to ensure the transaction appears on the ledger. In the eyes of the insurance algorithm, Chloe's marriage is thriving. This isn't just a lie. It is a tactical defensive maneuver against the predatory pricing models of 2026. However, the insurance companies have anticipated this. Historically, insurance fraud has always evolved alongside the technology meant to prevent it. In response to stability bots, theoretical underwriters have developed what they call anomaly detection for human authenticity. This involves looking for the perfection red flag. Real human relationships are messy, inconsistent, and characterized by occasional silence. If a couple's data shows a perfectly linear, high-frequency pattern of affection and joint activity for 18 months without a single deviation, the algorithm flags it as statistically improbable. The insurers begin to look for the digital fingerprints of the bot, the millisecond perfect timing of responses, or the lack of semantic variety in the messages. This leads to a high-stakes game of cat and mouse where the bots are programmed to include artificial flaws, deliberate typos, simulated cold periods, and realistic arguments, just to satisfy the insurer's baseline for human behavior. We see potential outcomes where the cost of these stability bots becomes a standard line item in a middle-class budget, much like a VPN or a high-end antivirus suite. It is a cost incurred solely to protect one's marital stability score from the prying eyes of the actuarial syndicate. Beyond digital simulation, we must look at the rise of alibi services and financial masking. If a spouse is preparing for an exit, they need to build a liquidity buffer without triggering an alert. In 2026, the traditional secret bank account is almost impossible to maintain because of the interconnected nature of the U.S. financial system and the Know Your Customer regulations that have been expanded to include marital transparency. To bypass this, individuals are using dark credit and non-traditional asset classes. Chloe might begin overpaying for household services, paying a trusted contractor or a specialized alibi service for home repairs that never happened, with the understanding that the funds will be held in a private, blockchain-based escrow account for her future use. These alibi services provide a physical and financial layer of protection. They might provide receipts for business conferences that don't exist, allowing a spouse to travel and consult with legal counsel or scout new residences without the insurance company's GPS tracking flagging the behavior as unauthorized separation. From a statistical standpoint, this creates a massive blind spot for the insurance market. If the most high-risk individuals are the ones most likely to use these masking services, the insurance company's data becomes skewed. They end up undercharging the exit planners, while overcharging the honest couples who are simply going through a temporary rough patch. This brings us to the concept of the marital forensic audit. In 2026, when a divorce insurance claim is finally filed, the insurance company doesn't just cut a check. They deploy a team of digital forensics experts to investigate the validity of the claim and the history of the policy. They perform a deep dive into the couple's data from the preceding 24 months, looking for evidence of financial masking or the use of stability bots. If they find that the couple has been gaming the score, they can deny the claim entirely based on a material misrepresentation clause. This is the ultimate nightmare for someone like Chloe. She spends years paying premiums and even more money on bots to protect her score, only to have the insurance company use that very deception as a reason to refuse the payout when the marriage finally collapses. The data suggests that this technological arms race is fundamentally changing the nature of American trust. When every interaction is potentially being recorded and analyzed for its risk value, the authenticity of the relationship is compromised. We are seeing historical trends where the performance of marriage, becomes more important than the marriage itself. In some social circles in 2026, having a high marital stability score is a status symbol, a digital certificate of being a low-risk human. But beneath that score, the statistical reality of divorce remains unchanged. The insurance product, which was meant to provide security, has instead introduced a new layer of surveillance and anxiety. We must also consider the role of the stability consultant, a new career path that has emerged in the mid-2020s. These are professionals who bridge the gap between relationship counseling and financial planning. They help couples optimize their digital footprints to ensure they qualify for the best insurance rates. They might advise a couple to take out a joint loan even if they don't need the money, simply because the act of successfully paying off a joint debt is a massive stability signal to the underwriters. It is a world where financial strategy and romantic life are so deeply intertwined that one cannot exist without the other. As we move toward the final parts of this deep dive, we have to ask, what is the end goal of this system? Is it to protect families, or is it to create a perfectly predictable, risk-free society for the benefit of the financial institutions? The statistical analysis of the theoretical market for divorce insurance reveals a chilling potential outcome. A society where the only people who can afford to get divorced are the ones who were wealthy enough to never need the insurance in the first place, while the rest are trapped in a cycle of digital performance and financial surveillance. In Part 9, we are going to look at the global impact and the international divorce arbitrage. We will explore how different countries are reacting to the American experiment with divorce insurance, and how high-net-worth individuals are moving their marriages to different jurisdictions to take advantage of more favorable risk models. We will analyze the data on marriage havens, countries with legal systems specifically designed to be uninsurable and untrackable. If the U.S. system becomes too restrictive, the world's elite will simply move their marital contracts elsewhere. We are going to reveal the specific countries where your marital stability score means nothing, and why that might be the ultimate luxury in 2026. The next part takes us beyond the U.S. borders to see how the rest of the world is watching the collapse of the private American home. The global response to the American experiment in marital risk management has been one of both fascination and profound alarm. In 2026, as the United States formalizes the integration of big data and insurance into the private home, the rest of the world is beginning to build what economists call the digital iron curtain of domestic privacy. While the American model treats a marriage as a high-frequency financial instrument to be hedged and monitored, other jurisdictions are positioning themselves as the last bastions of unquantifiable human relationships. This has given rise to a phenomenon known as international divorce arbitrage, a complex financial strategy used by the global elite to move their marital contracts into jurisdictions where the American stability algorithms have no jurisdiction. To understand this, we must look at the historical trends of jurisdictional competition. Just as corporations move their headquarters to Ireland for tax benefits or ships are flagged in Panama to avoid regulation, the high-net-worth individuals of 2026 are now shopping for marriage havens. These are countries like Singapore, the United Arab Emirates, and Switzerland, which have passed strict marital data sovereignty laws. These laws explicitly prohibit the sharing of domestic behavioral data with foreign insurance entities. For a wealthy American couple, moving their marital domicile to a haven is the ultimate luxury. It is the ability to live a life that is uninsurable because it is untrackable. Imagine a character named Julian. In 2026, Julian is a venture capitalist based in Palo Alto, but his marital contract is registered in the Dubai International Financial Center. Julian is well aware that if he were married under California law, his divorce insurance premiums would be tied to his every move, his spending, his location, and his social interactions. By utilizing a marriage haven, Julian effectively opts out of the American marital stability score. In Dubai, his marriage is governed by a fixed legal contract that does not recognize the predictive analytics of a US-based insurance adjuster. If Julian and his spouse decide to separate, the financial outcome is dictated by a private, pre-agreed formula that is shielded from the prying eyes of the American actuarial syndicates. This creates a massive statistical divergence in the global market. We are seeing potential outcomes where the American middle class is subject to intense digital surveillance to maintain their financial stability, while the global ultra-wealthy use jurisdictional hedging to maintain their privacy. The data shows that in 2026, the cost of registering a marriage in a data sovereign haven has become a standard expense for those with assets exceeding $10 million. These individuals are not just avoiding the premiums, they are avoiding the behavioral modification that comes with the insurance. They are paying for the right to have a marriage that is messy, unpredictable, and entirely private. Let us look at the step-by-step process of how this international divorce arbitrage works. First, a couple must establish a physical or legal presence in the haven jurisdiction. This often involves the purchase of high-end real estate or the establishment of a family office. Second, they enter into a marital choice of law agreement. This is a legal document where both parties agree that in the event of a dissolution, the laws of the haven will apply, not the laws of their place of residence. Third, they move their primary liquid assets into offshore trusts that are specifically designed to be non-transparent to American insurance underwriters. By doing this, the couple renders themselves uninsurable in the U.S. market. Because the insurance company cannot see the assets or monitor the behavior, they cannot price the risk. For Julian, this is a calculated trade-off. He loses the safety net of a divorce insurance payout, but he gains total autonomy over his domestic life. Historically, this mirrors the way the wealthy have always handled risk, through self-insurance and legal layering, rather than through the retail insurance market. But in 2026, the motivation has shifted from tax avoidance to data avoidance. The impact of this on the U.S. economy is significant. As the most stable, high-value marriages flee to international havens, the domestic insurance pool is left with a higher concentration of high-risk, low-asset households. This is a form of brain drain applied to the social contract. If the best risks leave the system, the premiums for everyone else must rise to cover the losses of the remaining pool. We are seeing a historical trend where the American domestic market is becoming a high-cost, high-surveillance zone, while the rest of the world watches to see if this model will eventually collapse under its own weight. In Europe, the reaction has been even more stark. In 2026, the European Union has expanded the General Data Protection Regulation to include the right to marital obscurity. This law prevents any company from using relationship-based data to determine creditworthiness or insurance premiums. The European model is built on the belief that the datafication of the home is a violation of fundamental human rights. As a result, the theoretical market for divorce insurance in Europe is virtually non-existent. This creates a fascinating case study in comparative economics. Does the American model, with its insurance-backed stability, produce more economic growth than the European model, which prioritizes social privacy? The data in 2026 suggests that while the U.S. housing market is more stable due to the mortgage continuity riders we discussed earlier, the European social fabric remains more resilient. In Europe, the divorce tax is handled through robust social safety nets and public housing policies, rather than private insurance products. This means that a European citizen like Alara in Berlin doesn't have a marital stability score, and her bank doesn't care if she is seeing a counselor. However, she also doesn't have access to a $50,000 liquidity injection if her marriage fails. She relies on the state while the American relies on the syndicate. This global fragmentation has led to the rise of the marital refugee. These are individuals who move from the US to Europe or Asia specifically to escape the surveillance of the insurance-driven financial system. We are seeing case studies of couples who choose to remain unmarried in the eyes of the US government, instead entering into private foreign partnerships to keep their domestic data off the grid. This is a radical shift in how we define the American home. The home is no longer a castle. It is a data-generating node, and for many, the only way to protect the castle is to move it to a different kingdom. But what happens when these global systems clash? In 2026, we are seeing the first major legal battles over foreign marital judgments. If an American insurance company has paid out a claim based on a US divorce, but a foreign court later rules that the divorce was invalid, or that the assets were hidden in a haven, who gets paid? The complexity of international family law is colliding with the high-speed world of digital insurance, creating a legal quagmire that can take years to resolve. For the average American, this means that even if you have insurance, your payout could be tied up in international litigation if your spouse has global interests. The statistical analysis of this global market reveals a startling truth. The more we try to insure against the risk of divorce, the more we create new risks of legal and jurisdictional conflict. We are moving toward a world where your marriage isn't just a contract between two people, or even a contract with an insurance company. It is a geopolitical statement. Where you choose to marry and how you choose to protect that marriage tells the world exactly how much you value your privacy versus your financial security. The ultimate luxury in 2026 is the ability to be invisible to the algorithm. For the wealthy, this is achieved through international arbitrage. For the rest of us, the options are narrowing. We are trapped in a system that demands transparency in exchange for stability. But as we reach the final part of this masterclass, we have to look at the terminal point of this entire trajectory. We have analyzed the math, the data, the legal wars, and the global impact. Now, we must look at the final evolution of the theoretical market. In Part 10, we are going to look at the post-divorce economy. We will explore the data on how this insurance-driven world eventually leads to the end of traditional marriage as we know it, replaced by a new form of liquid partnership. We will reveal the final shocking statistic that explains why the insurance companies actually want you to get divorced, just not too quickly. We are going to look at the circular economy of heartbreak and how the financial system is preparing to monetize every single stage of your life, from the first date to the final settlement. The loop is about to close, and the result is something no one predicted. The final part of the deep dive begins now. The final part of the deep dive begins now with the transition into the most disruptive economic shift of the decade, the emergence of the post-divorce economy. In 2026, we are witnessing the terminal stage of the data-driven social contract. For nearly a century, the American economic engine was fueled by the nuclear family, a stable, predictable unit that bought houses, cars, and consumer goods in a linear fashion. But the statistical analysis of the theoretical market for divorce insurance has revealed a much more profitable alternative for the financial syndicates. They have discovered that there is more total lifetime value in a society defined by marital velocity than one defined by marital stability. This brings us to the rise of liquid partnerships. Imagine a couple in 2026 named James and Linda. James and Linda are part of a growing demographic that has completely abandoned the concept of lifelong marriage. Instead, they utilize what the insurance industry calls term partnerships. When they decided to cohabitate and merge their lives, they did not sign a permanent legal document at a courthouse. Instead, they took out a 5-year renewable domestic policy. This policy functions as both a prenuptial agreement and a divorce insurance product. It sets a clear expiration date on the union, at which point the assets are automatically rebalanced, and the individuals can choose to renew their policy for another term or walk away with a pre-funded transition payout. From an actuarial perspective, James and Linda are far less risky than a couple attempting a traditional, forever marriage. Because their contract has a built-in exit ramp, the potential outcomes are perfectly predictable. The insurance company knows exactly when the liquidation event might occur, and they have already priced the cost of the split into the monthly premiums. For James and Linda, this provides a level of financial psychological safety that the traditional model lacked. They aren't afraid of a catastrophic divorce because they have already insured against it. But the deeper statistical truth is that the insurance company is the one truly benefiting from this churn. In the post-divorce economy, every dissolution is a massive injection of liquidity into the market. Historically, a divorce was seen as a wealth destroyer, but in the 2026 model, it is a wealth shifter. When James and Linda's 5-year term ends and they decide not to renew, the insurance payout triggers a series of economic events. They each need a new place to live, which benefits the rental and mortgage markets. They need to furnish 2 households instead of 1, which benefits the retail sector. They each re-enter the dating market, which benefits the massive tech platforms that manage social discovery. The financial system has effectively figured out how to monetize the end of a relationship with the same efficiency it used to monetize the beginning. This is the circular economy of heartbreak. The insurance companies have realized that a person who gets divorced and repartners 3 times over their life generates significantly more fees, premiums, and interest than a person who stays in one house for 50 years. By providing the insurance that makes divorce safe and affordable, the financial industry is actually encouraging a higher frequency of relationship turnover. They are not just managing the risk, they are managing the life cycle of your intimacy to maximize the throughput of the economy. Let us look at the step-by-step data on the re-entry market. In 2026, the first 24 months following the trigger of a divorce insurance payout are characterized by a 300% increase in individual discretionary spending. This is the fresh start phenomenon. Insurers now offer specific riders for this period, such as the lifestyle restoration benefit. This provides a cash stipend specifically for wardrobe updates, professional rebranding, and even aesthetic procedures. The logic is purely mathematical. The faster an individual can be repackaged and placed back into a new insured partnership, the faster the insurance company can begin collecting a new set of premiums. James, for example, receives a $40,000 payout from his policy the moment he and Linda sign their dissolution papers. $10,000 is earmarked for his new apartment deposit, $5,000 for legal administrative fees, and the remaining $25,000 is his re-entry fund. He spends this money immediately on a new vehicle and a high-end gym membership, both of which are tracked by his new single-status insurance underwriters to determine his new risk profile. His marital stability score is replaced by his marital velocity score. A high velocity score suggests he is a frequent consumer of partnership contracts, making him a high-value customer for the insurance syndicates. However, this leads to a chilling statistical ceiling. In 2026, we are seeing the emergence of the uninsurable individual. This is someone who has gone through too many partnerships too quickly, or whose data suggests they are unable to maintain even a short-term contract. For someone like Linda, if she fails to renew her next 3 partnerships, her premiums for future term policies will become so high that she is effectively priced out of the partnership market. She becomes a social subprime risk. Without the ability to secure divorce insurance, she cannot find a partner who is willing to take the financial risk of merging lives with her. We are seeing a future where your ability to love and be loved is strictly governed by your insurability. The final statistic that everyone should be aware of is the correlation of convergence. By 2026, the gap between a person's credit report, their health record, and their marital history has completely vanished. They are now a single unified data identity. If you look at the historical trends of the early 2020s, we saw the beginning of this with social credit experiments, but the theoretical market for divorce insurance has been the final nail in the coffin of privacy. The insurance company doesn't just know you are getting divorced. They know why, they know who you will date next, and they know exactly how much you will spend to feel better about it. We have reached the end of the masterclass, but the implications are just beginning to unfold. We have moved from a world where divorce was a personal tragedy to a world where it is a calculated financial transition. We have seen how big data, blockchain, and actuarial science have combined to turn the American home into a high-performance asset class. But as we close this loop, one question remains that the algorithms cannot answer. If every aspect of our relationships is insured, hedged, and monetized, what happens to the parts of us that cannot be quantified? What happens to the uninsured moments of true human connection that don't fit into a 5-year term or a risk-adjusted premium? The market for divorce insurance in America is no longer theoretical. It is the blueprint for the next century of social engineering. You are no longer a spouse or a partner. You are a policyholder in the most complex risk pool ever devised. But as the financial system masters the art of the exit, they are inadvertently creating a new kind of social ghost. People who exist entirely outside the system, refusing to be tracked, refusing to be insured, and refusing to play the game of marital velocity. In our next deep dive series, we are going to explore the rise of the off-grid economy. We will look at the people who are intentionally tanking their marital stability scores to disappear from the financial system, and the secret cash-only communities forming in the rural United States. We will analyze the data on why the most unsuccessful people according to the insurance companies might actually be the only ones who are truly free. If you thought the divorce insurance market was dystopian, wait until you see what happens when the algorithms realize they can no longer find you. The war for the human soul has moved to the shadow economy, and the next part of this journey begins where the data ends.